All right, we just talked about one of the aspects of getting a mortgage is your credit. What is credit? What goes into credit? First of all, there are three credit bureaus. There's TransUnion, Experian, and Equifax, and they all have different algorithms that they use to calculate your credit score. A lot of times people will call me and they'll say, Credit Karma says that my credit score is 700 or whatever. Just know that Credit Karma is similar to Zillow in that their estimations of what your credit or your home value might be are often not quite accurate. Another thing to know is that when you get your credit score online, that's often a consumer credit algorithm that you're looking at. And when you have your credit pulled for a mortgage, it's a different algorithm. It's a different credit model that's being used to calculate your credit score. The three bureaus each give a score. We use the middle score to determine which rate and what you qualify for and so on. It's not an average, just whatever happens to be the middle score of those three bureaus. Scores range from 300 to 850. You need anything above 500 for certain programs. Basically, though, really you want to be in the 600 to 700 plus. The closer you are to 700 or above, the better. As a loan officer, I evaluate your credit when you are applying for a home loan. What is part of your credit history? First of all, your most recent activity has the biggest impact on your credit score. So this was mind-blowing to me when I got into the mortgage industry, but something that I learned is that if you have a collection account and it's older, when you make a payment on that account, it refreshes it and it makes it a brand new collections account and it tanks your score. It'll drop your score. So weirdly enough, if you have an old collections account, let it go. You can reach out to the creditor and find out if you can arrange for a pay for deletions. That means you get in writing before paying it off from them that they will delete that collection from your credit report if you pay it off, if you settle with them. And deleting that collection from your credit report can help improve your score. So just know, if you have an old collection, don't make a payment on it unless you have a written agreement from the company that they will delete that from your credit report, or it will make it a new activity and it will drop your credit score. Other things that affect your credit score are hard pull credit applications, like when you apply to live in an apartment, or when you go to the store and they say, hey, do you want 20% off? Just fill out this credit card. And those kind of things can drop your score. Think of credit as your garden. In order for your plants to grow, you need to nourish them, you need to have good soil, and you need to continue to watch over them and make sure that they have a good environment. So the same thing with any credit line that you have. When you first plant it, you're going to be using your maximum amount usually that they give to you. And so that's not great for your credit score. But as you make your payments each month on that line, that improves your credit, that helps your credit grow positively, and that establishes a positive credit history and helps your score grow. As you do things that hurt your credit, things such as if you are late, if you go to collections, those things can hurt your credit. If you do a charge off, that's even worse than collections. Bankruptcy and foreclosure, those will also hurt your credit. They do not prevent you from getting a mortgage loan. Like years later, you can qualify still for a mortgage loan. It depends on the program and it depends on have you been able to build up your credit since then. Basically, the older your credit is, the less it affects your credit score, and the more positive payment history you can make, the better you can make your score and the better you can make your credit garden grow. The different mortgage loan types have different credit requirements. Generally, for conventional loans, I mean, you can go lower than 700, but you're not going to have as good of an interest rate, and your mortgage insurance premium is going to be pretty high compared to an FHA loan. When people are around that 680, 700 score or above, I'll look at conventional. I'll also compare FHA with them, because FHA loans are great for people who have lower income or have some credit issues, maybe a lower credit score. The difference with conventional and FHA is that conventional, if you put down less than 20%, then you do have a mortgage insurance premium until you have 20% equity in your home, and then it can come off. With FHA, that mortgage insurance payment stays for the life of the loan. Also, FHA has upfront mortgage insurance premium, which is usually financed on top of the loan amount at the beginning. If you have a 680 credit score or lower, I generally look at FHA. You can put 3.5% down on an FHA loan until 580. Once you are below a 580 credit score, then you need to put 10% down and you still need to qualify for the loan. VA loans do not have a credit score minimum. That is a lender overlay. It depends on the lender that you use. If you have been told that you're denied for a VA loan because your credit was too low, try another lender. That was lender overlay. Some lenders will go down as far as 500. Now, naturally, we need to make sure that you are a good credit risk and that you will make your payments. But things happen, sometimes when people are deployed or when you go through a divorce, it can affect your credit. And as long as you are a good credit risk, it should not affect your ability to buy a home. USDA also has similar guidelines to FHA. You'll want to talk to your loan officer to find out if you fit within the USA guidelines, because there are a lot. There are income limits and all sorts of things. But it's a great loan program if it works out for you.